Hello, everyone. We're going to go ahead and get started with the searcher and sell-side advisor relationship panel. And I will turn it over to our moderator from Live Oak, Lisa Forrest.
All right, thank you. Are we all on? Okay, great, thank you. Good morning, everyone, and thanks for being here and thanks for having us. I'll just start by saying that we kind of thought we were going to be in the other track, on the alternate track 2. We understand that using sell-side advisors and doing brokered deals might be more of a track 2 topic, but here we are with the track 1 on more of the traditional idea, so we're just going to dive in and get a little controversial potentially, so bear with us. So we're going to be exploring the sell-side advisor relationship with the search funder community. We know that there can be a little potentially trepidation on the searcher side to work with sell-side advisors, and sometimes there are misconceptions or misperceptions from the sell-side advisor side regarding the search funder community and what this community is all about. So we're here to explore all of that. And if we can accomplish 3 things, we'd like to try to help you optimize the buy-sell relationship, especially when a searcher goes in and realizes that there is an advisor on the sell side. We'd also like to prepare searchers, even if you're conducting a proprietary search, oftentimes, especially for interesting companies out there, oftentimes there's going to be a sell-side advisor on there, even if maybe the searcher wasn't expecting that. So we want to prepare you for that interaction. And then we'd really like to improve the process, your search process, increase access to deal flow, and help prepare you to get to that table so that you can offer your IOIs and your LOIs. So I'd like to introduce the panel. Again, I'm Lisa Forrest. I'm with Live Oak Bank, and I specialize in SBA lending. I've got a high SBA competency. I do senior debt, junior debt with an SBA foot forward, but we also have conventional lending for those transactions that require non-SBA. So I'm going to have the panel introduce themselves, and first of all, we've got Drew Gottenberg that is pinch hitting for Christian Berger, who missed his flight today. And Christian is with McGuireWoods, who's one of the nation's top attorney firms representing transactions. So one less attorney on the panel is probably a good thing. But anyway, that's enough of the attorney jokes. So Drew was very gracious in letting me volunteer him to pitch hit, and then I'll let everyone explain who they are and what their intersection is to the community, and then we'll get some of the conversation started.
I'll kick things off. Drew Gottenberg. So it's funny, I'm here because I guess I was standing in the wrong place at the right time.
No, perfect timing.
And it's actually kind of appropriate because it's kind of how I got into the search fund world. It started out as an investment banker and joined a client as a really innovative startup. We went through 3 rounds of growth capital, venture-backed company, and typical venture story. I ended up looking for what next to do after several years of growing that company and unsuccessfully. And so I have a really keen appreciation for cash flow, but I'm an entrepreneur at heart. And so what we've done is form a company, Spur Acquisitions, which accelerates the search process for entrepreneurs looking really engaged with operators who are seeking to own and operate a business and view the search process as a necessary evil. Well, what we do is make that process a lot more efficient and effective and enjoyable by creating a robust set of institutional framework and resources and infrastructure that people can come in and start searching on day one. We provide 100% of the funding needed to search, and then our investor network can execute on a variety of different deals. It's a diverse group of experienced investors, and so for each deal we can go target a different subset within that to execute on great terms and get good deals done.
I'm Greg Castelli. My firm is Gabriel Advisors. We're an investment banking firm located here in Chicago. We focus on kind of in odd-sized deals. So most of the transactions, whether we're on the buy side or sell side, are companies with a couple 100,000 of earnings up to a few million of earnings. Anything north of like 5 million is more the exception than the rule for us. So, as a banker, it puts us, in a position where there aren't a lot of other bankers chasing those deals. So we think we've carved out a pretty nice niche there. And as it relates to working with the search fund community, a lot of the companies on the smaller end of the spectrum that we're working with, not only are they not likely to attract traditional private equity, but oftentimes there's a legacy component to the deal that's much more important to them than to operators of the larger businesses. And so there can be an appeal to the owner-operator coming in to succeed the family that's running the company.
I'm Robert Meyer. I'm with the group, an accounting firm called Wipfli, and I'm part of the captive investment bank at Wipfli called WCF, or Wipfli Corporate Finance. Wipfli is a top 20 national accounting firm, and we're the 12th largest accounting firm in Chicago. I've been an M&A professional my whole life, for 20 years. Been a banker, investment banker for a number of those years at larger firms, bulge bracket firms, middle market firms, places like Berger, and then now what I consider to be lower middle market. I've also been on the corporate side, so I've been head of M&A for a publicly traded business. I've been a CFO of 2 software companies that were both sold, that I led through sale processes for both of them. So I feel like I've sort of been at all the different seats, which I think makes me pretty good at my job now, advising companies, mostly on the sell side. From a size range, we focus on 20 to 200 of transaction value, I would say, with, I always kind of laugh at ceilings of transaction values because happy to do something bigger. But smaller can be tough. But as it relates to what we're here to talk about, certainly always looking to expand buyer lists. A deal that I've got in the marketplace right now, we went out to 400 private equity funds. That's our group of buyers. So I'm not sort of snobby when it comes to kind of size of buyer lists, and some people snicker and say, oh, why do you have to go out to so many? And I'm a firm believer in sort of the numbers, the way the numbers work out. The more you go out to, the better chance of success you have.
Darrin, Shillair. I graduated from the Booth Evening program in 2016. In 2017, I launched Eagle Tower Capital, which was a self-funded search. And I recently acquired Specialty Sales, which is a wholesale distributor of industrial tubing and associated components. I acquired that business through a investment bank-led process where Craig was the sell-side representative on that transaction. So I have the perspective of the buy side and a searcher working with a representative through a brokered process.
Great, thank you. So searchfunder.com just conducted a recent survey asking what % of participants were conducting a proprietary versus a brokered search. And the results were 75% proprietary and 25% brokered. And I think that there is a sentiment that the rise of brokered searches is actually increasing. So if that's the case, hopefully our discussion topic will hit the mark in several points. So kind of to start off the discussion, what are some of the biases on kind of both sides of the aisle there, if you will? Searcher bias maybe going into what they might think of or expect from a deal that has an advisor on it. Darrin, I'll have you take that one, and then we'll segue into anyone that's open for discussing what the sell side advisor might maybe be, what their misconceptions or biases might be to the buy side searcher. So Darrin, why don't you start with that?
Yeah, I can start. I mean, I think that there's a bias within the searcher community that you are unable to buy a business at a fair price if you go through a brokered process, that price is going to be driven up through a broad auction process to a value that's outside of the range of what is going to economically make sense. I don't think that's true. I think especially at the lower end of the market, there are definitely represented businesses that can be had at appropriate values in cases where the business is too small to appeal to a broad set of institutional buyers, or where the sell-side representative is being instructed by that business owner and that seller to consider other factors other than just simply who can pay the most. So as Craig mentioned earlier, if there is a legacy component to that seller's wishes, and they're wishing to transition that business to the next generation of owner-operator, that's a place where a searcher can play. And your price is still going to have to be competitive, but it's not necessarily just simply a bidding war. So, I think that there is that bias within the searcher community, but I think that there still is businesses that can be acquired at fair prices through brokered process.
Anyone want to jump in, representing maybe the sell side, or?
Well, I would say a couple things. I mean, I think it's interesting to think about, since this is a somewhat of an academic-sponsored event. I mean, this concept of like a fair price, by definition, a broadly marketed process is sort of the fair price. But I would say if I'm doing my job, and this is what I tell sellers all day long, the prospects, the folks that I'm trying to earn the business from, if I'm doing my job, that business will sell for a higher price if I run a process versus if they don't. And going even further, when I have prospects approach me, and this is happening more and more frequently, I'm sure you can attest to this. I'm talking like, a lot of my client base comes from our accounting firm kind of clients, and I feel like once a week I'm getting an inbound from somebody that has been approached by a prospective buyer. It could be a search fund type of buyer, it could be private equity fund, it could be anybody, but they've been approached and they sort of now want to know what to do. And I'm telling them, if you go down the path with one buyer, you're not going to get the best deal. So I guess I'm sort of agreeing. I mean, forgive me if I'm a contrarian, but I mean, the bias is almost true. I mean, if a bank, that being said, so everybody wants to find proprietary one-off deals, right? And that's the value. That's why you were successful in what you did, and that's a great outcome.
Yeah, I mean, I think I share that perception that generally speaking, the searcher valuations are, I'll call it conservative. And, as we work with larger and larger companies, it becomes tougher to be competitive. But, I also have the perception that a lot of searches are overly general. If you really boil down the one page that we receive, it's, I have an MBA and I have a lot of capital behind me and I want to buy a company. And if you're searching around a very broad set of industries and a very broad range of earnings that also crosses over into what a more traditional private equity firm would invest in, it's really difficult to stand out. And these guys that have heard the story, but when Darrin and I first met, he had a different criteria. He was just starting out his search. It was, I can't remember if it was 1 to 3 or 2 to 5 of earnings, and it was this whole broad set of industries. And when we brought specialty sales to the market, it was a second-generation family business. They were very concerned about the well-being of the employees and the legacy of the owner's father who had founded the company. And we did a very tight initial search, and it was largely focused around searches of various profiles. I think the numbers broke down to 12 NDAs went out, 9 were signed, 5 IOIs came in, and then we brought in 3 to the management meetings. And Darrin didn't make the initial cut. And had it not been for one of the guys on my team walking into a happy hour, bumping into him, and Darrin saying, so I've decided to reframe my search a little bit, and then boiling it down a little bit further to understanding that he actually had a ton of experience in the specific industry, dealing with the types of products and the types of sales channels, and could talk that lingo with the owners, and it clicked. And then all of a sudden, from the first time they met, they both really wanted to make it happen. So it was very, very intentional, but it almost never came to pass.
Yeah, I can elaborate on that a little bit. I think that as I went through my search process, the initial conversation that we had was very much at the beginning of my search. So I was kind of out there under a very broad criteria, not necessarily industry focused, and was under the impression that I was going to buy kind of a traditional search fund sized business. Throughout the first several months of my search, I definitely refined that criteria, both in terms of size range and in terms of some more specific industries. So I think it's important, lesson learned, to circle back with some of the context that you may have made in the initial search to make sure that they're continually updated on what your criteria continues to be as you refine that.
And before we move on maybe to a different talking point, Drew, did you have anything to say about sort of the way sort of the searchers or sell-side brokers kind of view one another, given your particular point of view?
I think, look, everybody who is involved in any particular transaction is keenly aware of the misallocation of their time. It's what you have during the search phase. And as a representative on a seller's business, you're looking not only for the certainty that that buyer is going to be able to consummate the deal, but also that they can be trusted with the business. And so there's credibility and trust are two primary motivating factors there. And so I think what we've heard in this specific example is can be generalized to say the more specifics and the more targeted that you can be, the less uncertainty actually kind of persists throughout that relationship. And you know you're dealing with somebody who knows what they're looking for, they know what they're talking about, and they actually have somebody behind them that has enough capital to be able to pull the deal off. And then on the searcher side, I think going into it with a brokered process, if you don't have a pre-existing relationship with a broker or an intermediary, then there's a fact-finding period where you understand the types of representative transactions that they work on, their experience, and so you can then use that to kind of figure out, all right, how quality is this information that I'm viewing, and is my time going to be efficiently spent going through this sim and coming up with some initial parameters, and then secondarily, it's when I really engage, I know that I don't have a committed fund behind me, and so I need to not only acknowledge that up front, but hit it head on and talk about the different ways in which we can execute that actually could be a competitive advantage. So as opposed to having a more strict, tight box that this deal has to fit into, because it fits one specific fund mandate, you should be talking about how your investors with relevant experience are actually looking for this particular opportunity to reduce the uncertainty on the other end too, and really kind of form that relationship. If the deal doesn't go through, at least you've gone through one exercise of building a foundation of trust that can then carry forward into the next deal.
Craig, could you maybe further expand on that of how a search funder could establish credibility with someone such as yourself when you've got a lot of maybe buyer profiles coming at you? How best can we help really establish that credibility with you?
Yeah, I mean, I think it really comes down to clear articulation of a focused search. So if you're going to tell me that you're interested in manufacturing and industrials and distribution companies, don't just say that and then let me guess what type. Get more granular based on your experience, based on your knowledge of the type of company within those broad categories that you'd like to invest in. And then demonstrate that not only do you have the experience in the space, but you also know where you can be competitive. Our firm does a ton of work in healthcare. And if we just take dental as an example where private equity is crawling all over the dental space. If I have a dental services business with $2 million of earnings, I'm going to have 200 people submit bids on it. No joke. I mean, that is a platform for dozens of private equity firms out there. So if you're a searcher and you're building your criteria around 2 million plus of earnings and you think you want to go after the dental space, you better have rock solid plan as to how you're going to stand out in not only a hyper competitive valuation environment, but also just discerning the quality of the investor. And perhaps that's a cue to go below that financial threshold. I think a lot of it really has to do with the size range. If you dip below where traditional private equity is searching, you're going to see a larger volume of opportunities. And it's industry by industry in a way. It's company by company. But I think it really boils down to an intentional search that also demonstrates what you're searching for and why you're searching for that industry, that company profile, that size.
Yeah, I can elaborate on that a little bit. I think it does come down to a little bit of good old-fashioned relationship building as well. So, it's difficult to differentiate yourself when you're just sending one-pagers to every broker or every business banker that you can get a hold of, as opposed to actually meeting that person, getting to know them, leveraging your network so that you can get that warm introduction from a mutual contact so that you're not just another stranger who's reaching out to them trying to buy a business. Now, I ran a geographically focused local search, so maybe that's a little bit easier when you're trying to build a network and leverage that within your local community as opposed to nationwide. But I do think it's important in any sort of sales type role to build that relationship in order to bolster your own credibility.
And Robert, how does that work for you? If you've got buyers and you're trying to kind of weed through everything, what's a good differentiation point for you, and what does credibility look like to you?
Yeah, good. I certainly relate to the personal aspects of it. I can tell you that an inbound one-pager over email or any other way, for that matter, even a one-on-one meeting potentially at a conference or something, basically doesn't go very far, doesn't really get you anywhere. So it's really just about establishing that connection with somebody. So how do you establish a connection with somebody? You try to prove that you know what you're doing. How do you prove that you know what you're doing? You're able to articulate your experience and how you add value to situations as an operator, and then as a deal practitioner, as somebody that can actually get a deal done. You have to somehow prove that you can get a deal done, which obviously comes to all these other things that we're probably going to talk about, like financing and whatever else. So I guess I'm an advocate for that, the concept of a personal connection, making an impact on somebody at a personal level. I think when you talked about sort of a focused, targeted approach and granularity, I think that's a great point. And I think that ties right into what you were talking about when you mentioned geography. And it was easier for you so I think geography is just one aspect of a more targeted approach. It could be industry, it could be geography. I think from a searcher's perspective, I think the concern with being focused is that they're going to be excluded, right? If you say I'm only focused, you say I'm interested in industrials, maybe your experience is in valves and gaskets and hoses, but you say industrials because you don't want to say valves and gaskets and hoses because maybe there's a motors deal that you would be interested in, but you didn't list it in your. So, but I think it's really more about just creating the right impression on the person, so that granularity projects an image of focus and just being generally well thought out. So that's really the purpose it serves, is it's making us think that the person is well thought out, more so than we're actually tracking the list of verticals that he said. That's my perspective.
So I'd like to take the conversation maybe a little bit different way. Can you speak to maybe impressing the advisor or the investment banker, impressing that relationship versus actually impressing the seller? Are there relevant differences to the approach? Are there some examples you'd like to throw out? Because I know searchers want to get that conversation with the seller. So approaches, examples to that, handling that differently.
completely different, night and day. Totally different skill set, language that's going to be used, appeals that experience that you're going to lean to appeal to a sell-side advisor versus a business owner. And I think the reasons for that are somewhat obvious. Around the sell-side advisor is going to be concerned with your access to capital, your ability to get a deal done, your ability to work through that transaction process and understand the technical details of that process. The seller, especially with smaller businesses, are going to be concerned about your ability to manage that business and maintain their legacy going forward. And that really has nothing to do with multiples of EBITDA or capital stacks. It has everything to do with your experience in that industry, how it lends itself to their business, as well as your intentions for what you're trying to do with that business, as far as the growth of that business, how it's going to impact their employees, how it's going to impact what they've built. And that's a really rightfully so emotional thing for sellers. So it's a very different conversation than with an advisor who's really focused on a transaction.
Yeah, I mean, what I would add, just kind of extending that point, is that especially on the smaller end, these companies are like an additional child to the business owners. And, they may have spent 30, 40 years, they've spent more time around this business than any other relationship in their entire lives. And they have, a pretty deep passion for it. And so you have to, exude a similar passion, as they have, to the business. You have to be able to articulate why this particular company and the vision that you have. You have to be able to tell a story. Those of you who were up here in the last panel, may have heard Austin talking about, telling his story and how, he doesn't want it to come across as BS, but there's a story element to it. I mean, I don't think it's BS at all. I mean, if you're passionate about something, you're going to tell it as a story. You're going to articulate it in a way that others, will gravitate towards. Whereas, when it comes to, impressing the advisor, it's all the things that Darrin said. And I mean, the one thing I'll add, on the sell side, we're selfish, right? We want to look good in front of our clients. So, convince us that you're somebody we can put in front of the seller and not regret down the line for, any number of reasons. And you've got a good shot of getting through.
And I would just add, I would suggest that you lean on the relationship that the sell side broker, banker has with the company owner to tailor and customize the approach with the business owner. Because we're sort of talking generalities up here, but the guy hasn't owned the business for 50 years. It's third generation. It might be a third generation. He's owned it for 50 years, and he wants all the employees to be taken care of. But it might not be the case, and maybe he's focused on other things.
Yeah, definitely. So, you can ask the sell-side advisor,
Right.
What does this seller care about?
Right.
What's important to them? What are some things that might appeal to them?
Right. Help me. I want to make a good impression. You tell me what are the factors that are going to resonate.
The only other thing I would add is listening is extremely important. So asking questions, diving deep, really developing a real honest and earnest interest in the person behind the business, with more specifically for a business owner, but it relates with any counterparty where there's a tendency to build up your own talking points in your resume and everything that you want to go convey, and then that dominates a conversation, and the impression that gets left is not one of somebody that's relatable. It's just somebody who's just giving me a pitch, right? So I always would recommend that you start by asking questions and listen, and then when it's appropriate, start talking about yourself.
Thanks. And so one last question, and then we'll turn it over for Q&A. Your 30-second advice. Your bit of advice, 30 seconds, max.
Okay, wow. So I would say keep your conversations brief and to the point, and make commitments, and then follow through and deliver at every step along the way.
Give me one, no more than two specific things to remember you by so that when that opportunity arises in the future, you're top of mind?
I would say get smart on industries and verticals of your choosing. Get real smart and passionate, and I think that's a really good way to differentiate yourself. And it's easy to do just from a research perspective.
I would say don't underestimate the value of relationship building. So differentiate yourself by being something more than an email and a piece of paper, and get in front of people and put in the work.
And my piece of advice is really get a good deal team on the buy side. Make sure you have a really nice deal team around you. Your banker, your accountant, your due diligence, and your attorney. Make sure you've got a really nice team of folks to help on your side, because the sell side is really going to respect that you have a good set of advisors around you as well. So with that, I will open it up for Q&A.
So from a valuation perspective, other than a multiple of earnings by industry, what else do you look at and how important is it?
I would say the two ways to think about value are cash flow and assets. So there's all sorts of metrics aside from EBITDA. Whether it's obviously revenue, recurring revenue, whatever. But then there's, particularly in the lower middle market, there could be an asset-based type of valuation where the earnings might be very low to approaching zero. But there's hard assets either in the form of inventory or working capital that can support a valuation above a traditional cash flow based valuation. Does that answer your question?
Partially, but what else? What other factors would you consider? I've heard things mentioned like, does the former employer care about his employees, things like that. So
other factors.
So again, you can have solid numbers, and it's fairly straightforward. But in a negotiation process, as a buyer, what do you look at, or how do you make a best deal as a buyer?
Yeah, I don't know that the former owner caring about the employees plays so much into the valuation. That plays into selection of a buyer and a willingness to sell to a buyer who may not bring the highest sticker price because you're factoring other things, but in terms of intrinsically valuing the company, I don't know that comes into play. I know one other thing that we look at when we're going through the sell side process is financial valuations versus strategic valuations, and what the gap might be, because in some sectors it can be quite large between a searcher, other financial investor, and a larger operator in the space.
Questions?
Great. Thank you so much for your time, first of all. Secondly, have you guys seen an increase in the use of seller financing, and how is there a stigma around using seller financing to close a deal?
I mean, no business owner understands it out of the gates. They all think that you're using their money to buy the business. But I think in the majority of transactions that are pushing the upper limits of a normal valuation range, there's some type of holdback, whether it's a note or an earnout or an equity roll or some compensation beyond just cash at close.
And I'll say from a senior debt perspective, and I'm speaking from the lower middle market, sort of more SBA, self-funded, independent sponsor voice, typically all of our transactions will have seller financing. And seller financing can be a good way to mitigate something in the transaction. Each deal has its own nuances, of course, so the seller note is a good way to help kind of get through whether it's a transition risk or if it's just making sure that all of the deal points really get executed post-close, and that seller note is just kind of part of our deal transaction for the most part.
Hi, my name is Harry Shaw. I'm a self-funded searcher just like Darrin. Darrin, my question to you is that in my search, I come across two types of brokers. One are pretty much just like used car salesmen, and the other ones are similar to what Craig's doing. In your search process, how did you manage these two kinds of intermediaries, and how did you approach them? I just want to understand from your point of view.
Especially in the lower middle market, there's a huge variation in the level of professionalism in the kind of broker banker community. There's everybody from what Craig is doing, which is running like a real investment banking process in a very professional shop in the lower middle market, all the way down to the guys that only communicate via text message and they've just got buddies and they're selling their business. And the interesting thing is that there's not even a particularly strong correlation there between the level of professionalism and the quality of the companies that they represent. There are guys like that are flying by the seat of their pants that really do represent good opportunities. So my recommendation would be not to overlook that and to meet those guys on their level and play the game, I guess. If they want to communicate by text message and meet up for beers at 10 in the morning, that's what we're going to do.
Just one follow-up question. Did you transition to intermediary-led search from the proprietary search, or you pretty much, how did you come across Craig?
It's a longer discussion on my search methodology, but because I was running a lower middle market geographically focused search, I focused heavily on relationship building of all kinds. So all service providers, every attorney, accountant, wealth manager, outsourced CFO that I could get a hold of, I was telling my story to. So that's what I was using for proprietary deal flow. And I included sell-side representatives in that type of relationship building to get that inbound volume as well. So I didn't do as much of the traditional cold reach out search methodology that you'll see from some of the traditional searchers. But
thank you.
Hi, this is sort of a lead on, Darrin, to that comment you just made about how you sort of introduced yourself to all potential intermediaries or advisors. But as someone who traveled from Salt Lake City today, hearing Robert's comment about a single meeting not probably cutting it, I'm trying to think about, okay, how can I leverage my time most effectively in a market like Salt Lake that isn't maybe as well versed in the ETA model? Are there ways that you would recommend specifically that someone like me could network with potential advisors or find them more specifically?
I would say leverage your existing network. So you know people that are in the business community, whether they're service providers or sell-side advisors or not. Email people that you know and who can vouch for you. Ask them to make introductions to these types of service providers and tell them what you're looking to do and the type of people that you're trying to meet. And I think that's a good way to get started. One warm introduction turns into the next, and you could build a broad network that way, and then have a systematic way to keep in touch and keep those relationships warm as you continue the search.
And I'll just say, I apologize if that was discouraging, but I think our interaction is actually a decent example, because we had a first meeting, but then there was many follow-ups after that. And it turned into mutual, hope it was mutual reach outs, where he would reach out to me, I would reach out to Darrin. So, and it's kind of, think about like a sales, traditional sales role or sales funnel. I mean, it's like, there's stats on this in terms of like, the effectiveness of one reach out. A sale that's made after one reach out is like, less than 1%. And usually they take like 8 reach outs or 12. I mean, the numbers are crazy. So think about it more like that, I would say.
Great, thanks guys.
I would also just add to that, that in any process where you're talking about, hey, I'm an operator and I don't have my own capital, but I'm using other people's capital, the natural question is, well, who, right? So spend some time certainly lining up relationships with the ultimate investors well in advance of the effort, so at least you have a couple people to point to, and certainly in many cases, investors will be willing to join you on a site visit if you get that far, or at least be comfortable with you referencing them as a prospective capital provider in the transaction.
Yeah, and I would say that goes for both equity investors as well as the lenders. So get your lenders involved early in the process. Understand really what is going to get through underwriting as far as an amount of leverage to put on a deal, so that you're not submitting IOIs or LOIs that are totally unreasonable. Either Craig and these guys are going to know that, and they're going to, you're going to lose credibility immediately, or even if they were to accept it, then you're going to have to, renegotiate that later if it's not realistic and it doesn't work. So.
How many deals do we look at together?
Several.
Several, but which is great, which is part of our relationship. And as a senior lender, my process is to work through as many SIMs and recasts with Darrin as possible to put him in the best position to submit a real reasonable LOI or IOI that can actually get done. So working with your lenders early on is absolutely necessary.
Yeah, just a quick story. This is a true story. I was introduced to somebody within the last year-ish who's a searcher. And he discovers that we have some expertise in an industry. He says, hey, I have this company under LOI, and here's the multiple, but I don't really know how I'm going to convince my investors to pay that. And we're looking at it, and he's one, if not two turns above what should be standard for that industry and that size. Don't do that.
Hello, Jonathan Dunn. It sounds like the sell side process, if you're looking to do a managed process, you could utilize your services, represent the sell side as a coach to kind of understand the things that the buyer may be interested in to get the deal closed. What are some of the things that you, from your experiences, and maybe vast different examples, that have been the reason why deals haven't closed from the search process?
There's a ton of reasons. I think a common thread is lack of communication and mismanagement of expectations. It's just kind of there's a tendency to kind of not address some of the more controversial items until later on in the process. And,
like working capital.
Yeah, exactly. Yeah, personally, I just find it more efficient to try and knock out the hard things first. And hope you can get an agreement on the main terms, and then the rest becomes negotiating details, and then transactions still fall apart all the time. You guys can speak to war stories.
Yeah, we have very few. It's usually either a seller has unrealistic expectations about a valuation or a specific deal term, and we do our best to qualify that up front and move on from working with them if that's going to be the case. But every once in a while, either we're misled or we misread a situation and expectations can't be met, or if there's a fundamental business change, a process can be 6 to 12 months, and things can happen internally within the business through that period of time, which may lead to a retrade and an owner saying, well, I don't know that I want to do this anymore.
Hi, you guys mentioned multiple times about how important it is to be very specific in the industry that you're looking for and coming in with kind of a focus and understanding and depth of knowledge. I'm curious from the perspective of someone who's approaching you, how do you feel when they come back and maybe change their mind, or they say, I really loved valves, now I'm actually looking at healthcare, and I think there's an opportunity here. From your perspective, do you guys see that person as like a flip-flopper? Is this just like a natural part of the process? Do you lose credibility? And what are some things that maybe we can do to ensure that we don't lose that credibility?
If you can answer the question why, I don't think you lose any credibility. But the why should be about more than just there's an opportunity in this category.
I agree. I mean, I don't have any problem with somebody changing or pivoting or whatever. I think it shows maturity and depth of thought, and I feel that way about with politics too. So I don't know.
Thanks.
Great, thank you. I think we have time for one more question. Okay.
So you touched upon earlier sort of seller paper and the willingness to accept that. I'm kind of curious about earnouts and if that's something that's acceptable on the seller side, and sort of what percentage, to the extent that you can speak of that, in terms of like total deal amount ends up getting done.
I mean, from my perspective, seller paper and earnouts are inferior to cash up front. So that's just one component when you think about a bid and the competitiveness of a bid. So it's inferior. Some sellers actually like earnouts and want earnouts, which is interesting. But they really believe, and usually sort of like wrongfully, like they're too close or overly optimistic. It's like that classic case. But in terms of percentages, I mean, an earnout, if it could be, I wouldn't say any more than 10-ish% of the overall purchase price in the form of an earnout. I don't know if you guys feel any differently.
Yeah, I mean, I think there's a little bit of, industry and company specificity that goes into it. You might see strategics in a certain industry, put earnouts on every deal, and those earnouts might be, 20 or 30%, but their valuations are already 50% higher than everybody else's. So if you compare the cash component, the seller still wins there. I think that's the biggest thing.
Businesses that really rely on the owner, those are the ones that always have earnout components.
Yeah, I've seen owners like earnouts, like Robert was saying, when they're high growth businesses, and it seems like every 3 to 6 months, if you look at a trailing 12 months, the valuation ticks up. So between any time you go from IOI to the end of diligence, they've grown enough, and they say, well, wait a minute, I think we should reprice this. And at a certain point, they just have to accept valuation at a point in time. But the earnout really solves that.
Can I ask you a question? What advice would you give to folks to be aware of how the seller note interacts with an SBA loan?
Sure. So again, more for the lower middle market, if you're using an SBA loan, which comes with a personal guarantee for anyone who owns 20% or more of the company. So again, seller notes are a real typical structure in my world. And the seller note is subordinate to our senior lien, our senior debt, and there can be cash flow coverage covenants associated with that seller note, such that if post-close debt service coverage falls below a certain margin, the bank's in first position and could suspend seller note payments. So, those are deal points to understand, but the seller note is generally accepted in the lower middle market as a way to get a transaction closed, and seller would prefer all cash at close, but there's other interests involved from the senior debt perspective and from the buyer perspective.
I think to add to that, one thing that I thought was interesting about the interaction of the seller note and the senior debt is that seller notes, a typical market seller note, isn't as long as a term compared to the SBA notes. SBA notes are a 10-year term. So in some cases, you can actually help your cash flow by moving purchase price from the seller note into a longer term senior debt position. So that not only helps your cash flow, but also should improve the attractiveness of your offer if you're reducing the amount of that seller note in the capital stack. So something to think about.
Yeah, and to that point, generally in lower middle market deals, the seller note is actually usually a small piece. My senior debt could be 70, 75, 80% of the transaction. It's a very leveraged, highly leveraged transaction with at least 10 down from the buyer, and then usually a small seller note. So it's going to look different than non-SBA or conventional structures. So the seller note's small generally, and that's why it's generally an accepted deal structure. Did I answer your question? Excellent. Great. Well, thank you very much. We've come to the end of our time. Thank you for your time, and a round of applause for our panelists, please.